We have a SIBI here. So it's a daily fair value gap, SIBI. The candle is down. Down candles that make a fair value gap is a SIBI. Up close candles that make a fair value gap is a BISI. Okay, so this inefficiency here forms at what part of this monthly fair value gap SIBI? So in other words, between this range high and this range low from the monthly chart now, where is this SIBI forming? In the lower half of it. Did you notice that? High to low, that pink range. Halfway point's about right here. So the high of that SIBI also is in close proximity to the consequent encroachment, which is not labeled here, of the high and low. You might want to include that in your chart. But this SIBI stops right there because not only is it the high of this imbalance, but it's also consequent encroachment of the monthly fair value gap SIBI. So now notice what we're doing. We're observing, we're appreciating and recording the logic behind nested PD arrays. There's a convergence, if you will, of PD arrays and levels that would otherwise go unnoticed by you or anyone else out there. And these are the types of things that I have done in the past, years ago, when I would do recorded executions. And people would say, you know, why is he trading there? Like, what's so significant about that area? It's things like this. And I can say it in passing. Say, hey, look, yeah, it's a monthly fair value gap, and check your charts for homework. You want to look at the monthly chart. There's an inefficiency around that price level. But see, you don't want to do that. You just want to watch me do a new trick. You want to see me do some new teaching and not dig into the charts yourself and appreciate what it is I'm laying out there for you on a silver platter. But I'm not going to spell it out for you, not because I don't want you to learn it, because I want you to go into the charts and do this very thing here, which is what every one of my profitable students are doing and have done. You're not going to be the exception. Stop arm wrestling it. So we also have this area here, which is a what? Fair value gap. But think now, if this is an inefficiency and it's a fair value gap, what kind of fair value gap is this? Buy side imbalance, sell side inefficiency, just like this one is down here. But what does this become if this area up here is creating some measure of a likely price delivery going lower? And then we see support behind that idea where price does this very thing here. As soon as this candle trades down below these lows and below this candle's high, which is the low of this buy side imbalance, sell side inefficiency, which is a fair value gap, this pass through of this candle here makes this and this a potential what? Inversion fair value gap. What time frame does it form on? The daily chart. See, we're up here, daily. So your annotation here is the daily inversion fair value gap high, which is this candle's low, and this candle's high, which is the daily inversion fair value gap low. An inversion fair value gap is narrative based. If we take away the context of it wanting to go lower, prior to this lower, this is just simply a fair value gap buy side imbalance, sell side inefficiency. But as soon as we have price deliver to the sell side and then attack sell side liquidity and pierce the low end range of that buy side imbalance, sell side inefficiency, this sets the tone if narrative is considered, and we've already established that early on that we were looking for lower prices. So that means we can use the midpoint or the low or the lower quadrant. Notice there's 3 specific levels there, not a zone, very specific price levels. Midpoint, well, what's the midpoint of an inversion fair value gap? The same thing that we would call the middle of a fair value gap. The same thing we would call the middle of a wick or a tail, consequent encroachment. So we see the daily inversion fair value gap, consequent encroachment, is right there. Notice we have this inefficiency here, which is what? Daily fair value gap, SIBI. So anyone else watching my videos, if they don't really go through the process of doing this or learning or take good notes, they're going to assume that the market's going to go all the way back up to here because they'll say this is a liquidity void and the market's going to want to have to go up there. Not when it's like this. Like what? We have a higher time frame monthly fair value gap. We went up and repriced to it. We went up to it one more time, halfway, consequent encroachment. And we also rebalanced this area here because we went up into repricing it and then we left the range there. So now this is a balanced price range. And we have 1, 2 premium arrays supporting what? Lower prices. So as soon as we pierced through this low here, this level here, not that very candle, this low of the inversion fair value gap. We don't know it's an inversion fair value gap until price does this pass through. Then we can anticipate the market likely to reach up into the midpoint between this candle's low and this candle's high, and that midpoint is daily inversion fair value gap, consequent encroachment. So the midpoint between this level here and this level there. We trade up to here, trade lower, and close there. Next candle, we open, trade up one more time, trading above the previous day's high, trading up into consequent encroachment of the inversion fair value gap. And what is this candle here? This big beefy candle. This is for the folks that like to say my order blocks are engulfing candles. That has nothing to do with it. This candle here is the bearish order block. Notice this candle does not pierce or engulf this previous candle. Whoops, there goes that logic. So it's the change in the state of delivery, which is the opening price here. As soon as that opening price is pierced to the downside right there on that candle, this becomes a bearish order block. Now, because this is an order block, we can take that range from the low to the high. Halfway point of that is what? Consequent encroachment? No. Mean threshold. So we extend that to the future, and it would be in this area here. But we have what? What do we have here? We have this inefficiency from this candle's low, this candle's high. Would we reasonably expect, if we have the inversion fair value gap, consequent encroachment, which is half of this buy side and balance sell side inefficiency, the midpoint of that, if we have that, and we have the opening of this bearish order block, and potential institutional order flow entry drill, we're expecting lower prices, and we have an inversion fair value gap. Can it go back up to the inversion fair value gap high? Yes. The chances of it doing that are slim. By far and large, many times you're going to see that inversion fair value gaps, given this type of movement where we've moved up 5 months one direction, we hit a premium array. There's no reason really to go up to the high of the breaker, and because the breaker is essentially a pattern that you want to trade the low or mean threshold of. You don't want to see it trade the high end. If it does, it becomes a little less likely. Doesn't mean it can't go there. It just means that I don't like to see that. And if it does that and I'm in a trade, I will scale something off to remove the measure of risk that I'm holding if I see it trading to the high of the breaker. Because if it trades to the high of the breaker, it means that it's not as bearish as I want it to be. And you don't want to see it trade up there. If it's bearish, it shouldn't get all the way up there. Same aspect that's being shown here. If we have this SIBI from this candle's low and this candle's high, and we have this one big candle trade down like that, do we really want to see it trade above the daily inversion fair value gap high? No, we don't want to see that. Just like we wouldn't want to see it trade on the monthly bearish breaker high. Because if it's bearish, we want to see premium arrays not be reached to. Let me say that again. If we're bearish, if we see premium arrays in our PD array matrix, in the fractal that we're studying in price action, that means all the data that's being shown here. If we can clearly identify where specific liquidity resides or where a premium PD array is in price, if we're really, really bearish, we do not want to see premium arrays traded to. We want to see discount arrays draw price to it. And everything smash through down close candles. Because what is that telling us? Order flow is bearish. Did I have to show you a DOM for that, a depth of market? Did I have to show you a VWAP? Did you have to see a point of control? How about a volume profile? Did you have to look at volume for that? No. Everything is in the candlestick. Everything. You just need to know what it is you're looking at by time. So we also have the weekly premium wick consequent encouragement, which was being respected. Look at the bodies right there. See that? Did any of the bodies cross over that? Nope. But we did have wicks go through it. And that also teaches you what? By annotating your chart like this and seeing how the lower time frames go through it just a little bit. But when it does that, and if you're bearish, you're going to start to condition yourself and say, okay, this is acceptable. And this is why I say this is permissible in price action, where you might get scared out of it, or you might put your stop loss just above that, thinking that it's enough. It's not enough. But I'm not scared or changing my opinion about where the market's going to go, because there might be a small little mohawk, little deviation outside of the levels I'm looking for. This is all normal coloring outside the lines. Okay. This algorithm is my baby. It's my child. So when I look at price action and it colors outside the lines, I'm still going to take this chart and hang it on my refrigerator, hang it on my desk. Okay. It's something my child has done. And I know that this is my child's fingerprints. So I don't worry about these things when I'm looking at it. And I'm not judgmental of what price did in these areas when it's normal to see that very thing. And you won't grow anxious when you're studying price and it's behaving this way, because it's something that you expect and it's likely to occur. Where everyone else might get scared or stopped out, or they may even change their opinion about where they think the market's going to go because the market creates these little wicks. At the time watching it, this is a full-blown bullish green candle. At the highest high of that, when it touches the candle low there, real time, I'm expecting it to just bump just above it a little bit and then recede back into the range. When you start doing these types of annotations, it conditions you to anticipate that very thing. So when you are watching real-time price action or tape reading, you will have that in your mind because you've seen many examples of it. And then when you start getting real comfortable with it and it happens to do that very thing, it feels really good. It's a confidence builder. It's not an overconfidence creator. It's a confidence builder. And it builds this understanding about price action that you would never otherwise get unless you were actually doing these types of things and recording it and showing snapshots over time, not just, I did it for 2 weeks ICT, I'm done backtesting. No, you're not. And journaling is something you're going to do the rest of your career. You want to be able to annotate and log everything. And the more you pour into this part of it, the better you're going to be. So we wouldn't want to see this area up here in this SIBI be traded to. We don't want to see that, because above the daily inversion fair value gap high, we have this separation from this candle's low and the high, which is this candlestick low. That's the inversion fair value gap high. And right away, if this is one of the first times you ever watched one of my videos, this isn't where you start. Okay, this is for people that have been with me for a while and they just want to know how to journal. So before you even get to this part, you got to watch some videos. Okay, there's a lot of things you need to look at. And then if this is the first time you watch the video, watch my 2022 mentorship, 41 videos. Okay, just watch that one and it'll give you some context. But then the market opens here on Wednesday. We open, rally up, and then crush the sell side liquidity. And we go below the low, the daily inversion fair value gap. That makes this low a real low of the inversion fair value gap. The market trades the next day on Thursday. It opens, rallies up, touches the low of this candle here, which is what? That's your bearish order block. It can trade to that level and up to the opening price. Can it just stop and dead in its tracks? Yeah. But what do we allow for? Coloring outside the lines. So that opening price extended forward, what are we seeing right here? The same element of price delivery that's going on right there. This is a mohawk. This is a mohawk. It's absolutely permissible. Why? Because the market dynamics and the underpinnings of the marketplace is it's wanting to go lower. So it's willing to go lower, likely to go lower. Anytime it goes to a premium array that does touch, it does deliver to, anticipate a little bit of coloring outside the lines and not freak out thinking it's going to give way, which is the reason why I have a rule of 3 PD arrays. One, the first one, it can do this and then that's all there is. It can do this and then trade into the second PD array that I would be viewing as a defense. But if I have 3 PD arrays, if I'm bearish, if it trades through 3 PD arrays, I'm probably wrong. And if I haven't been stopped out, I'm going to take the trade off and remove myself from risk. Many times, and you watched me recently trade a live trade in the NQ or NASDAQ, real futures contract, not a demo. You can see that over there on my Twitter account. I was in a trade and I had 1 PD array of the 3 breached, and it was approaching the second one. And my third one was so close and right above my second PD array that if it went to my second one, I was going to collapse the trade entirely and remove myself from risk. So it's a matter of knowing all these things that you just can't get from an ICT video one time. There's no way to compress and put all this bandwidth into one single individual presentation. Not and have the precision that you see me sharing and what my students are able to utilize on their trading. So this area up here becomes what? Between the daily inversion fair value gap high, which is this candle's low, to this candle's low here, that makes this what? A breakaway gap. Ooh, it's not annotated. Right, it's for you to go in and dig into it. So we see it trade up into the bearish order block, opening price, and trades above this candle's high right there on Friday, which is a institutional order flow entry drill. What is that? It is a entry taken that would be inside of a imbalance like a fair value gap. What is this? It's a fair value gap. It's shaded. It's a daily fair value gap. What kind? SIBI. That means it's a down candle that delivers the fair value gap. Just the opposite of what a BISI is, okay? BISI is a fair value gap that has an up close candle. SIBI, the way you remember easy is, SIBI is sell side delivery, sell off. BISI, buy side delivery, buy up. Okay, that's the way you can remember it. We don't want to see this area traded to because why? We have this high here that it could trade to and create a turtle soup. Trade up above it and reject and go lower, which is what it did. But how far can it go above that ICT? The opening price here, this is your bearish order block. That should change in the state of delivery right there. And it can go up to that area there and go through it just a little bit, which is permissible price action. Coloring outside the lines. And then we see delivery aggressive throughout the day and going lower, taking out Thursday's low, digging deeper into this buy side imbalance inefficiency right there, and it's a daily based PD array. The next one is the weekly bullish order block propulsion block. You can see now that we're on a daily chart, it didn't quite get there yet. That would be my next assumption for, if it goes lower, and then obviously the entire closure and delivery back to this candle's high.